The practice of money laundering is pretty widespread. According to The Economist, the United Nations Office on Drugs and Crime estimates that somewhere between $800 billion and $2 trillion passes through the rinse cycle every year. In other words, it amounts to 2 to 5% of the entire planet's GDP. With global financial markets on the rise, money laundering is easier than ever. A country's bank secrecy laws are directly connected to its bank reporting laws. One can anonymously deposit quote-unquote dirty money in one country and then have it transferred to another country for use. Hello and welcome back to the Finance Guardian channel. For today's video, we'll dive into the world of money laundering and how it works. So hit that subscribe button and the bell beside it, and let's get started. For you to understand how money laundering works, you first need to know what money laundering is. Money laundering is a form of financial crime used by criminals to disguise the source of their money. In this way, dirty money appears clean, resulting in a frustrating situation for law enforcement agencies that are trying to bring criminals to justice. The concept of money laundering describes the process of acquiring funds through criminal activity, mixing them with legitimate funds, then returning them to their original source. Criminals can then cash out laundered money without being caught. Now, in many cases, the money that has been laundered is being used to finance the operations of criminal organizations. This practice is associated with various illegal activities such as general fraud, drug trafficking, theft and embezzlement, tax and customs violations, and terrorist financing. Criminals move the money to a place less likely to attract attention. In addition, when money is laundered, the authorities have difficulty prosecuting criminals and recovering dirty money under the Proceeds of Crime Act. How do money laundering schemes work? Many criminal organizations resort to extreme measures to conceal both the source and the destination of illicit funds. Consequently, how money is laundered is constantly changing, and jurisdictions and businesses sometimes have difficulty keeping up with legislation in the face of evolving financial crimes. Despite these problems, money laundering is generally thought to involve three stages: placement, layering, and integration. Most involve suspicious activities, but that doesn't necessarily mean they're easy to spot. Stage 1. Placement. This is when the launderer remits the dirty money to a legitimate financial institution. Usually, this is done through a bank deposit, and large amounts of cash are conspicuous and banks must report high-value transactions. So this is the riskiest stage of the laundering process. Stage 2. Layering. The money is sent through various financial transactions, altering its form and making it difficult to trace. It is possible to layer cash through several bank-to-bank transfers, wire transfers between accounts in different names and in foreign countries, deposits and withdrawals to continually alter the amount of money in the accounts, changing the currency of the funds, and purchasing high-value items such as yachts, houses, cars, gold, and diamonds to modify its form. This is the most complicated step in any laundering scheme, and it is all about making the original dirty money as difficult as possible to trace. Stage 3 is integration. Money in the integration stage re-enters the mainstream economy in a legitimate-looking form, which gives the illusion that it came from legal transactions. This may involve a final bank transfer to the account of a local business in which the launderer is quote-unquote investing and will receive a cut of the profits, the sale of a yacht purchased during the layering phase, or the purchase of a $10 million screwdriver from a company owned by the launderer. The criminal now has the opportunity to use the money without getting caught. If there is no documentation during the previous stages, it is challenging to catch a launderer during this stage. Electronic money laundering. Thanks to the internet, a new twist has been added to the old crime. With the advent of online banking institutions, anonymous online payments, and peer-to-peer transfers on mobile phones, it is becoming increasingly difficult to detect illegal money transfers. Additionally, proxy servers and anonymizing software make it almost impossible to detect the third component of money laundering, integration, because money transfers or withdrawals can be made without leaving a trace of an internet protocol address. The ill-gotten money can also be laundered through online auctions, gambling websites, and virtual gaming sites. It is converted into gaming currency and back into reliable, usable, and untraceable clean money. Bitcoin, for instance, is the newest frontier for money laundering. Despite not being completely anonymous, they are increasingly used in blackmail schemes, drug dealing, and other criminal activities due to their relative anonymity compared to more conventional forms of payment. And most anti-money laundering or AML laws have been slow to adapt to these types of cybercrimes since they still focus on detecting dirty money as it moves through traditional banking channels. Authorities that investigate money laundering. Investigations of suspected money laundering activities are carried out by several different governmental agencies. Money laundering investigations are conducted primarily by the FBI and the IRS in the United States. Now, in recent years, money laundering has become such a significant problem that there are now international agencies specifically designed to combat it. The International Money Laundering Information Network, the IMOLIN, is a research center created by the United Nations to assist law enforcement agencies worldwide in identifying and pursuing money laundering operations. The Financial Action Task Force on Money Laundering, the FATF, was established as a G7 initiative to develop more effective financial standards and anti-laundering legislation. Because money laundering plays a key role in financing terrorist organizations, the FATF is also required to directly intervene to cut off the circulation of illegal cash to terrorists and terrorist groups. The IMOLIN and the FATF work closely with Interpol and domestic police agencies in the G7 nations: the United States, Canada, the United Kingdom, France, Germany, Italy, and Japan. Is money laundering a serious problem? The consequences of money laundering can be devastating for the economy, national security, and societal well-being. Corrupt public officials, terrorists, illegal arms dealers, and others rely on it to operate and expand their criminal enterprises. Criminal activities are becoming more and more international in nature. Rapid progress in technology and globalization's financial services industry has complicated the financial aspects of crime. And as I noted at the beginning of this video, almost $2 trillion, or roughly 5% of the world's GDP, is estimated to be snatched by money launderers every year. It has a staggering impact on the global economy, society, and security. Economic effects are more widespread. Governments in developing countries often bear the brunt of modern money laundering since they are still establishing regulations for newly privatized financial sectors. They are, therefore, prime targets. It was widely rumored in the 1990s that banks in developing Baltic states had large deposits of dirty money. Bank customers began withdrawing their own clean money for fear of losing it if the banks were investigated and lost their insurance. This led to the collapse of the banks. The world's economy has also been plagued by errors in economic policy resulting from artificially inflated financial sectors. Bringing a large amount of dirt into the economy desirable for money launderers creates a false demand for economic policy, and officials respond to this by adjusting conditions out of necessity. Suppose the laundering process gets too complicated or law enforcement officials become increasingly interested. In that case, all this money will suddenly disappear without any predictable economic cause, and the financial sector will collapse. Taxation and competition among small businesses are some of the more local problems. In general, laundered money is not taxed, meaning we all have to make up for the lost tax revenue. Moreover, legitimate small businesses cannot compete with money laundering front companies that can offer products at a lower price since their primary purpose is to clean money, not to make money. Their cash flow is so strong that they might sell a product or service below cost. Most investigations into money laundering in the world concern two major industries: drug trafficking and terrorism. If drug money is successfully cleaned, there will be more drugs, crime, and violence. Money laundering plays a crucial role in the sustainability of terrorist organizations, although the connection may be more complex. Most people who financially support terrorist organizations do not simply write a personal check and give it to a terrorist. The money is sent through multiple channels that maintain anonymity and fund terrorists. Similarly, terrorists cannot purchase weapons, plane tickets, or civilian aid with credit cards or checks. They launder the money so authorities cannot trace it back to them and foil their planned attack. Interrupting the laundering process can cut off funding and resources to terrorist groups. And that's all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, subscribe to our channel to remain updated about all of our future videos. We'll see you next time.